now recognize the gentleman from California, Mr. Sherman, for 5 minutes.
I want to comment on one success story. Several years ago, there were $16 trillion of LIBOR instruments where the amount the debtor was supposed to pay the creditor was to be determined by the London Interbank Rate. And as of June of this year, that rate will no longer be published. Something happened unusual here in Washington. A year and a half before the LIBOR hit the fan, Congress acted. You published your regulations in February, and the problem is solved. I want to pick up on the ranking member's comment that it's critical that we deal with housing. There's a lot we can do in Washington, but we also need to get cities to allow the construction of apartment buildings and condos. Someone has talked about the de-dollarization. We need to compete against the euro and against the yuan, but one place where Congress can act is with regard to crypto. The crypto billionaires have told us they want to displace the dollar. They're working for de-dollarization. And when billionaires tell you they are trying to hurt your country, you should believe them. There's been a discussion here as to whether it's the pandemic or Washington, D.C. policy that's caused the inflation. We have a perfect test case. Our annual inflation rate is now at 4%. The European Union, where Mr. Biden is not president and Mr. Powell is not head of their Federal Reserve, the European Union is, in May, had 7.1% inflation. The unemployment rate in the United States is 3.7%. The European Union is at 6%. And since the pandemic began, GDP has grown in the United States 5.3%. In the European Union, only 3.1%. I think it's pretty apparent that our policy has turned out to be actually better than Europe's policy. Banks and bank regulators have said, oh, how could we possibly have anticipated the inflation and interest rates of 2023? Today we have 4% inflation. That is almost exactly the average inflation rate over the last 50 years. Much lower than it was in the Reagan administration when we had 13.5% inflation, 16% interest rates. And that's why I blame the management and also the regulators at Silicon Valley Bank for telling us that, oh, this was an unanticipated circumstance. It's certainly one of the things they could have anticipated. I'll point out that both the Congressional Budget Office and the University of Pennsylvania Wharton School of Business's models both show that the estimated effect of the Inflation Reduction Act on inflation will be statistically indistinguishable from zero. So we'll accomplish a lot for the environment and not increase inflation. Of course, the recent action by Republicans to take away IRS enforcement will lead to higher deficits and higher inflation. The chair of the committee tells us we don't need regulation of our well-capitalized banks. Why are they well-capitalized? Because of our regulation. And I do want to focus on whether our banks really are well-capitalized. Mr. Powell, are our banks well-capitalized if you value their assets at today's fair market value, where we have experienced higher interest rates and the value of the debt declines? And are they well capitalized even if you assume that depositors are not just going to leave their money lying in the banks, but that the obligation the bank has to its depositors is valued at full face value, but the marketable securities and loan portfolio is priced at today's interest rates? Under those circumstances, do we have a well-capitalized banking system?
So I think you have to take the capital requirements as they are for purposes of this
Well,
question.
that's the problem. Our capital requirements are hide the facts that are unpleasant.
Right.
If you don't hide the facts, are we well capitalized?
Traditionally, though, as you know, a rising rate environment has increased the value of the deposit franchise, which more than or at least offsets any portfolio losses.
So we're well capitalized if depositors continue to be lazy and stupid.
The gentleman, time.